CPI inflation beat. Yes, inflation came in cooler than expected and now hitting the lowest rate we have seen since March 2021. Is this going to turn out to be the key pivotal turning point where everything starts to improve and we head into our next exciting bull market? I'm going to break down exactly the news we just got and what this means for the wider market, including some bits which are still kind of holding the market back and making it a little bit nervous. If you appreciate these updates, don't forget to smash up the likes. Do not forget to subscribe. Guys, yesterday we covered off the PPI inflation, which is your wholesale inflation. Today we got our CPI inflation, which is your consumer prices. And this is the one that the Fed looks at along with PCE inflation. So CPI is considered arguably the most important inflation metric. This came in at 2.9% versus the expected 3%. And it met expectations on all the monthly parameters and on the core inflation parameters. What that now means, if I show you a visual representation, is that inflation is officially notched down below the 3% mark. It now has a 2 handle, which is really, really important because if you look at what the Fed say and what Jerome Powell has continued to say at their FOMC meetings, they say we want to head towards our 2% target. And they want to see meaningful improvement towards that 2% target. And you can see now that is really starting to happen, right? We're really starting to notch ourselves down from the crazy peaks and starting to get some control again to head us back down to that 2% target. All of this ties in nicely with what the market is expecting will be our first official rate cut in just 5 weeks' time, on September the 18th. So you can see here, look at the market right now, and this, again, expect this to kind of fluctuate over the next kind of couple of hours, but half market participants are saying, you know what, forget just one cut. Jerome Powell just needs to get ahead of the curve and do a double rate cut. He needs to do 50 basis points. And so this is something we have to watch out for. In other words, what 50 basis points would mean is a bit of an interesting one because a lot of people would sit there going, hang on, if Jerome Powell was to do a double rate cut, surely that would create excitement in the market. Well, I would also put out the idea that, hang on, if Jerome Powell does a double rate cut, markets might actually dump. Because what markets will then interpret it as is, oh, Jerome Powell, you're not ahead of the curve, you're behind the curve. We thought you know what you were doing a soft landing. Right? So you've got to be careful with how market participants interpret some of this data. I personally think Jerome Powell's going to go ahead and do 25 basis point rate cut. And it's really important to understand for those who aren't kind of used to these rate cutting cycles or haven't studied them. It's important to understand that the actual rate cut in itself doesn't do much, right? The Fed funds rate going down by 25 basis points when you're sat here at 5 to 5.25 isn't going to change anybody's life, right? Their mortgage payment's not suddenly going to get massively lower. It's not going to, the car finance payments aren't suddenly going to get a lot easier. But what it is a signal from the Fed, from Jerome Powell and his team to say, you know what? We dealt with this. We brought inflation down to a 2% handle. We feel like it's going to come lower, 2.7, 2.6, 2.5, 2.3 until we're comfortable. And I feel we're sufficiently tightened enough for me to start edging off the brake. I don't need to be pressing that brake as hard as I was. I can just slowly start depressing it, and that could bring us to a slow and gradual stop and bring that inflation to control. If he does the opposite, which is do a double rate cut, which half the market is kind of trying to price in, that could give the counterintuitive effect, right? Where it can basically telegraph to the markets to say, oh man, I was a bit late. In the last meeting in July, I should have just cut rates then. So be careful what you wish for here in terms of the rate cuts. I think a nice 25 basis points would be great. It'd be great if you follow that up with another one in November and another one in December when we get 3 sets of rate cuts and finally we're down to that kind of 4.5 to 4.75 level. Okay, so you can see that majority of the markets here, 43% of the market in fact, by December the 18th, after the final 3 Fed meetings this year, expect us to be 4.25 to 4.5. Okay, so they're pricing in quite a few rate cuts. I think it'll be between 3 to 4. I'm leaning towards 3, 25 base points at each meeting. But again, it depends on the data. But another important thing to understand before I get into the Bitcoin chart is the market will now move away from just looking at the price data. The market will now say, you know what? Prices are under control. We've seen PPI, we've seen CPI. We feel confident with that. Now we want to focus on jobs. Give me the new jobs figure. Give me company earnings. What's going on here? Are companies growing? Is there demand? Do we have a recession? right? That's what the focus is now going to switch to over the next kind of couple of weeks and months, is what is growth like? And of course, we've got to ladder onto that the Japanese yen carry trade as well. We covered that over the last kind of couple of days. We saw that crash the market initially. We can't just ignore that. If Bank of Japan's inflation continues to climb, and they feel like they need to do another 25 base point rate hike, which they said they wouldn't do, but let's say they change their mind, again, more of that yen carry trade could start to unwind, and that could create some selling pressure. So all of that to say, look, we're still in a consolidation period here on Bitcoin, and we have been. And the patient people will be rewarded. It's not fun waiting this many months in a consolidation. And it never was. It wasn't fun being in the bear market either. This is not about fun. This is about pragmatic investing and doing what others aren't willing to do, right? Having control of your emotions and being able to study the data and the patterns in the past to make informed decisions for the future. And right now what I see when I look at the chart is I see a consolidation. And I've been saying that for a while. This is, for me, I can't tell you what to do. I can't give you my conviction. I can give you exactly my portfolio, but we won't get the same outcomes. Because you have to build your own conviction. You have to study the charts and your thesis and why you invested, right? Because if Bitcoin crashes today down to 45K, how many of you will panic and sell, right? I can't control that. You can take your phone out in the morning and just start selling because you're panicked. It's important you have conviction and you understand and you have a game plan. For me, the game plan right now is simple. I like DCAing here close to the EMA ribbon. Nice nibbles, right? If we fall lower and we lose our EMA ribbon, which is like a daily close kind of down to these levels down here, which you're talking more 53,000 weekly candle close below, then we got to go, okay, this uptrend is now finished. This has been a nice steep uptrend. If we lose the weekly candle, okay, maybe we're going to go sideways for a bit or even pull back. We need to analyze that. But for now, there's no reason to cry. We're just running into our EMA ribbon after a very, very long extended move from the 20,000s up towards 74,000. It's okay for Bitcoin to want to cool off. I mean, fundamentally, I'm not getting shaken out of this market right now. For me, it's the most silly time to be shaken out. We've been through a bear market. We've seen risk rotate off. We've seen the steepest interest rate climbs we've seen in a very long time. You've seen a dip in luxury purchases. You've seen a dip in risk on buying. And I think all of that is about to rotate back on. The question is going to be, are we in a recession and do we need to navigate 1 or 2 quarters of negative GDP growth before we can trigger that next bull run? Either way, like I share at the end of most of my videos over the last kind of couple of days, when I sit here and I look at the options that the Fed has, time and time again, what does it remind you of? The Fed has one trick. They have one trick. They tighten their policy, then they loosen it, right? They start printing money and they want to put money back in the economy. Hey guys, here's another stimmy check. Please go buy stuff so our economy functions. And they do that at the expense of your hard-earned fiat currency and your dollar, your pound, your euro, whatever fiat currency you're holding. And fundamentally, when I sit here and I look at the charts and sometimes, I'm guilty of overcomplicating it, I just zoom back out and I remind myself, hang on, I'm holding this because fundamentally, fiat currencies over time will devalue. That's all central banks know how to do, is increase liquidity and print more when, the proverbial hits the fan. And ultimately, that's what I want to be prepared for. When they're printing and they're stimulating economies again and they're loosening monetary policy, I want to be getting into hard assets. That's Bitcoin, that's immutable, that's permissionless. Nobody's just going to print some more. Hope you enjoyed this video, guys. If you appreciate this type of content, don't forget to smash up likes. Don't forget to subscribe. And I'll see you in the next one.